You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Centrica, Rightmove, Primary Health Properties, Airtel Africa, Reckitt Benckiser, and Coinbase. Sam, shall I kick us off with, a stalwart of the show?
Absolutely, and one you used to own.
And one that I used to own. I don't know whether I'm going to be sad or not. I don't think I am, actually. So Centrica's first half revenue fell by 10% to £11.9 billion, driven by lower commodity prices and price volatility. Underlying operating profit nearly halved to £549 million, but this was still better than the market's forecasted consensus being £531 million, and the beat was driven by stronger than expected performance in the infrastructure division, which helped offset weakness in the retail and optimization divisions. Free cash flow fell from £816 million to £244 million due to decline in profits. Underlying net cash fell from £3.2 to £2.5 billion. Centrica Energy, the group's energy trading arm, is expected to report full-year underlying operating profits towards the lower end of its medium target range between £250 and £350 million. All other retail, energy, supply and optimization businesses are expected to deliver underlying operating profits within their medium target ranges. An interim dividend of 1.83 pence per share was announced, which is up 22%, and the shares were down about 1% in early trading. In terms of valuation, Centrica has a market cap of £7.8 billion and trades at 1.74 times forward price to book, compared with a 10-year average of 2.53, and it has a prospective dividend yield of 3.8%. I mean, I think these results were a bit disappointing, but not entirely surprising, and it was still better than expected. I think with these energy suppliers, they are price takers, not price makers, and you don't get that impression when the politicians sort of talk about them, but that is the reality. As they've said, with lower commodity prices and the price volatility, that has impacted them. And I think going on to the political point, which is, I think, really, critical in understanding these businesses. I had invested myself, and it was, getting on for 10 years ago. It was less politicised then, and you didn't have the price cap that came in under Theresa May. That really did damage Centrica, and it marked the end for sort of, I wouldn't say political neutrality, but that the utility companies could be those solid dividend plays that they were for a good period of time after privatisation. That stopped being the case, and Theresa May was the first to sort of really go back in and fundamentally change that. As an investor, obviously that's very problematic. There was at the time a lot of price switching. That's now ended. A lot of those companies, those sort of startups, were pretty badly run and they went under, particularly after that price volatility and the energy price cap after the Ukraine war started. But I think fundamentally, Centrica is a pretty good business and it is well run. It was very unhealthy 10 years ago, but it has certainly been turned around. I think the main issue with it is that there's such a high level of political interference with it that for me, it made it largely uninvestable. You look at the balance sheet and it's clearly, it's got loads and loads of cash. However, I don't think it can really realise its potential given the level of intervention. If it is successful, it just draws things like windfall taxes on it. I suppose the other side of it is that how much can it, actually grow anyway in terms of the nature of the business. But if it does try to return that to shareholders, then, it draws criticism. I think the other thing that's very different to what it was like 10 years ago is that when it was paying a dividend of, let's say, 5.5% back in an ultra low interest rate environment, that was quite attractive. However, you have more volatility with it because of the political interference. And when you've got higher interest rates and effectively risk-free returns on gilts, which are quite tax efficient as well, why would you sort of look at Centrica? And for me, that's why I wouldn't go any further with it, and one of the reasons I got rid of it. What are your thoughts, Sam?
I'm just wondering, do you know what level the windfall tax actually kicks in? It says there's no specified profit threshold. So I think it kicks in basically just when the government decide, but there's not actually a minimum level of profits, I think, before it kicks in. How I'm reading it. So I just think from 1 November 24, the windfall tax of 38% just applies to all UK oil and gas extraction. Although I guess that's not...
It's largely moved away from that, but...
Yes, they might not be that affected, but I think there's still a huge political target. And as you've highlighted, they take the price, they don't set it. 10% drop in revenue, and all of a sudden operating profits been cut in half. The yields, I don't think that great, or they've got a lot of cash. And I think that's partly because if they're seen to distribute too much, they might just put themselves under political fire. But although they're probably not that affected by the windfall tax, I would say they're in an industry where if someone's looking to raise some extra money, they're probably all right with these results. But if they start doing much better, they will very quickly become a target again. So yeah, because of that, I appreciate they're not directly in the firing line at present. But for me, that just makes them uninvestable.
No, fair enough. Okay, on to one that I think we both like.
We do, and both own, I think.
Yes.
So Rightmove have come out with their first half results, and revenue was up 10% to 211.7 million. Operating profit was up 10% to 145.4 million. Underlying operating profit was up 9% to 151.3 million. Interim dividend per share was up 9% to 4.05p a share. Basic earnings per share was up 14% to 14.1p a share, and the underlying basic earnings per share was up 11% to 14.7p a share. We've said the revenue increase of 10% came as estate agency and new homes developer partners invested in upgrading their packages and purchased incremental products. Total membership increased 1% across agency and new homes compared to June 24. The underlying operating profit margin now stands at 71%, and they're reflecting planned growth-focused investment, which is consistent with the full-year guidance of a 70% operating margin. 112.4 million of surplus cash was returned to shareholders through buybacks and dividends, with 1.2% of outstanding share capital purchased and then cancelled. Cash and equivalents was up slightly from 41.3 to 42.4 million, and the average revenue per advertiser grew by £112, which was predominantly product-led, with particular strength in new homes. So on average revenue per advertiser increased by £112 to £1,609. Agent formation returned to levels not seen since 2020 as the market is more conducive to new entrants. New homes' marginal increase reflects continued low levels of new build developments coming to market. Average total membership across the first half of the year was up 1% compared to first half of 2024, with estate agency branches up 189, which is 1%, and new home developments up 73, which is 3%. They've highlighted sustained traffic growth with a total of 9.1 billion minutes spent on the platform in the period, up 10% from the prior year, which is the second highest on record, and the share of time was stable. Over 85% of traffic was direct and organic. We've said financial markets currently expect further cuts to the current Bank of England base rate of 4.25% by the end of the year, with the lowest two-year fixed mortgage rate at 30 June 2025 of 3.8%, down 88 basis points year on year. In resale, sales agreed in the first half were 6% ahead of the prior year, while completions were up 22%, supporting pipelines and agent confidence. In June alone, new listings and demand were up by 9% and 6% year on year respectively, a positive backdrop for the remainder of the year. For the full year, we continue to expect revenue growth of 8 to 10%, benefiting from the full year impact of Optimizer Edge update, further product-led growth across our core property business, and continued progress within our strategic growth areas of commercial property, mortgages, and rental services. We continue to expect approximately 1% growth in membership and average revenue per advertiser growth of £95 to £105 for the year across estate agency and new homes. Second half will see ongoing revenue growth, but following last year's record second half, we expect the year-on-year revenue growth percentage to be lower than the first half. We continue to invest in innovation, value delivery, and we expect an underlying operating margin of 70% for the year. In terms of valuation, the business now trades at a trailing PE of 32.5, but on a forward PE, it would only be 27.5, and the current dividend yield is 1.19%. As a shareholder, I don't think there's really anything to be unhappy about in these results. I think there's no criticism of the business at all. Very happy with how they're doing. The only kind of gripe I would have is on the valuation, but that's not the business's fault. I don't think I'd be comfortable buying it at current levels, but it's such a good business that it would probably have to get a bit pricier before I considered selling it. What about you, John?
Yeah, I mean, I thought these were a great set of results. I'm very happy owning the business. As you say, it's quite a toppy valuation, but it does just keep putting up these numbers. And we saw with the bid for it, it's obviously recognised as an incredibly high quality business, probably one of the best on the FTSE 100. And what are the profit margins on it? They're about 70%?
Operating profit, yeah, not bad.
Yeah. So fantastic. Yeah, I don't have a huge amount more to add. I suppose one thing is that, growth ahead is more limited and it's very saturated in the UK. It's probably limited in scope to the UK. There are some huge, US companies that dominate the market over there. I'm not sure actually about the European market, who the players are there, but I think probably the scope is more limited for expansion.
Well, we know who the player is in the Baltic.
Yeah, well, we certainly do, and we do like that a lot. But it's even more expensive than
it is.
So, yeah,
Rightmove's the value play in the sector.
Yeah, well, yeah, you could possibly make that argument. So, shall we move on to something that is more of a value play? Primary Health Properties.
Absolutely. How are they doing?
So they had their half-year results out last week, and the group announced that there was a 3.1% rise in net rental income to £78.6 million. Growth was largely driven by rent reviews and property upgrades, with a smaller contribution from recent acquisitions. Underlying income grew at a slightly slower pace of 2.2% to £47.3 million due to a 4% increase in financing costs. Occupancy remained stable at 99.1%, and the portfolio value was broadly flat at £2.8 billion, and the loan-to-value ratio rose marginally from 48.1% to 48.6%. No new information has been released about Primary Healthcare Properties' proposed bid of around £1.79 billion for the rival property company Assura Group, and the Assura board has recommended PHP's bid to shareholders, who have up until the 12th of August to cast their vote. So very, very imminent. Dividends totaled 3.55 pence per share over the first half, which was up 2.9%, and the shares were broadly flat in early trading. In terms of valuation, PHP has a market cap of £1.28 billion and trades at 0.88 forward price to book, and has a prospective dividend yield of 7.5%. For reference, Assura currently has a market cap of 1.6 billion, and as I mentioned before, the bid is 1.79 billion. But we'll see what happens with that. In terms of these results, I mean, we have been covering Primary Health Properties fairly regularly of late, and I don't think there were any surprises here. It's basically what we'd expected. I think the main news is about Assura, and we're going to get the big update on the 12th of August when the results of the vote are released. I think Primary Health Properties looks pretty attractive now. I think the only qualm I think you could possibly have is about the loan to value, and that is pretty high. But I suppose given the certainty and security of the tenancies, it's probably, it's more acceptable than it would be for other properties. And looking at that dividend, it's pretty good at 7.5%. And if it consolidates with Assura, then you've got a really pretty dominant player in the industry. And I think the price with a player of that size that it can hoover up sort of surgeries, yes, it's more expensive to refurbish them and get them back onto sort of long-term leases, but I'd back them to continue to do that. I think the message from Wes Streeting is that he wants more care delivered in the community, and realistically, the money for that, you see it coming from sort of a private partnership with a big player like Primary Health Properties. I can't imagine many smaller surgeries and sort of indebted trusts wanting to do that. So I think it plays, potentially very well, and particularly the type of people who are going to be selling the buildings are going to be selling for reasons, whether it's retirement or not wanting to still continue to invest. And I think that's where Primary Health Properties and what may become sort of Primary Health Care Properties and Assura can drive a pretty hard bargain. So yeah, I'm quite interested, and it's very high up on my watch list. I'm not at the point where I'd actually consider probably buying some shares soon. But anyway, that's my take on it. What do you think, Sam?
Very similar. I think the results, they're fine. I think what you're really paying for, obviously you've got that very nice dividend yield, but the 99.1% occupancy is just fantastic. I think the Assura deal makes a lot of sense if it goes through. And they have said that they will partly bring the debt down with asset sales at that point. I'm not overly concerned about it, but yeah, it's on my watch list as well. It's probably still working its way up. It's fairly near the top, but there's quite a few things that I like at the minute. So
yeah, that's the problem.
Yeah. But yeah, I do like it. I think there's a lot to be said for it. It's just, it wouldn't surprise me if in 6-12 months I pulled the trigger on it. But as things stand, there's other businesses I'd rather own more of, I think, or add before buying that. But yeah, I do like it.
Yeah, and you always know if you did buy it, American private equity might come knocking at some point too.
Well, yeah, but if you're thinking of buying it, it's probably best that I don't, because I've not had a huge amount of luck recently. But I just bought Auction Technology Group and Novo Nordisk, and both of them have both had days where they're down 20% in like the last couple of weeks. So
what happened with? I know Novo, and I'm sure we'll come on.
Yeah, I'm sure we'll cover that next week or something. But
what happened with, just briefly, with Auction Technology Group?
So there's a profit warning, and they've also announced an acquisition. So I'm assuming it's mainly the profit warning. The acquisition looks fairly okay.
Yeah.
Albeit, I think it might be being funded with debt. I can't remember now.
Okay.
But, mainly the profit warning, but
yeah, that's fair enough.
Still, it's all right. Just bad timing.
Yeah, absolutely. And don't time the market, or don't attempt to time the market.
No, I don't. Don't attempt to or time it anyway. Right, should we move on to a business that we've done much better in?
Yeah, no, absolutely. So Airtel Africa, Sam, how are they doing?
A favourite of the show and one we both own. So they have come out with their, I think it's a Q1 results. It is the Q1 results. So in terms of the GAAP figures, revenue was up 22.4% to $1.415 billion, and all these figures are reported in dollars. Operating profit was up 33% to $446 million, and profit after tax was up 408% to $156 million. In terms of the alternative performance measures, the EBITDA margin was up 282 basis points to 48%. Earnings per share before exceptional items was up 48.6% to 3.4 cents, and the operating free cash flow was up 48.4% to $558 million. Total customer base grew by 9% to 169.4 million, with data customers increasing 17.4% to 75.6 million, as a focus on bridging the digital divide across the markets continues. This, alongside a 4.3% increase in smartphone penetration to 45.9%, contributed to accelerating demand for data services, with data average revenue per user accelerating to 18.5% in constant currency, as data usage across the network increased by 47.4%. Airtel Money continues to play a pivotal role in fostering financial inclusion, with a 16.1% increase in customers to 45.8 million. As use case continues to expand, customers are increasingly engaging with a wide range of offerings, supporting a 35% increase in annualized transaction value to $162 billion and average revenue per user growth of 11.3%. Our strategic focus on great customer experience is underpinned by sustained network investment with the rollout of over 2,300 new sites to reach 37,579 sites and an expansion of our fibre network by 2,700 kilometres to over 79,600. This investment continues to drive increased data capacity across the region, with 4G population coverage reaching 74.7%, an increase of 3.4% from a year ago. The acceleration in constant currency revenue growth from the previous quarter reflects not only the impact of tariff adjustments in Nigeria, but also a strong performance in Francophone Africa, reflecting the continued execution of our strategy focusing on customer experience. Across the group, mobile services revenue grew by 23.8% in constant currency, driven by voice revenue growth of 13.9% and data revenue growth of 38.1%. Mobile money revenue continues to see a strong growth trajectory with 30.3% in constant currency. So the prior year period was significantly impacted by derivative and foreign exchange losses, primarily in Nigeria, whilst the current period benefited from a $22 million gain arising from the Central African franc appreciation during the quarter. CapEx of $121 million was lower compared to the prior period, driven largely by timing difference, and the guidance for the year remains unchanged at between $725 and $750 million. They've continued the debt localization program, aiming to reduce foreign currency debt exposure, with almost 95% of operating company debt, excluding lease liabilities, now in local currency, up from 86% a year ago. Leverage has increased from 1.6x to 2.2x, primarily reflecting the $1.3 billion increase in lease liabilities arising from the tower contract renewals, as previously disclosed. Lease-adjusted leverage remains flat at 0.9x. And if we go into the Airtel Money results in more detail, which they now actually have started giving, I think because they're planning to spin it out as a separate business next year and they want to drum up some interest. So for Airtel Money, revenue was up 30.3% in constant currency, as mentioned, to $290 million. And that was broken down by Nigeria, where the revenue has increased from $1 to $2 million. So I suppose that's good because Nigeria is the biggest market for everything else. So hopefully they've still got quite a bit of room to expand in there if they're only at 2 million. East Africa has increased 29.6% to $216 million, and Francophone Africa by 30.7% to $72 million. The EBITDA was up 28% to $153 million, and that gives an EBITDA margin of 52.7%. Operating profit was up 28% to $143 million. So that gives an operating profit of $143 million on revenue of $290 million. So you're basically at 50% operating profit margins. Not quite at Rightmove levels, but not bad, especially for a business operating in Africa. Operating free cash flow up 29.2% to $149 million. And as mentioned previously, in terms of the KPIs, customer base increased 16.1% to 45.8 million. Transaction value was up 34.5% to 40.5 billion. And that was just for the quarter. And mobile money average revenue per user was up 11.3% to $2.1. I think this is just fantastic. And I think this is really what's been driving the share price growth. I think getting to see just how we always knew it was good. But I didn't expect mobile money, but the mobile money figures to be that good. And I think when that's spun out, it's going to be quite a high multiple. So I think that's now starting to be reflected in Airtel Africa's price, which has done very well. It's up 87.8% in the last year. In terms of valuation, the business trades at a P of 36.5. However, in terms of free cash flow, it only trades at 8 times free cash flow. So I think it's still fairly reasonable. And the forward dividend yield is 2.6%. I'm very happy with these results. The only real issue we'd had recently was the issues with the Nigerian naira, which kept getting devalued. It's nice to see that stopped. Wouldn't surprise me if that started again at some point. I think it's just the nature of the beast. But yeah, those Airtel Money results look absolutely fantastic. So I think I'll be probably holding on to my shares once that's spun out separately. What about you, John?
Yeah, no, I mean, fantastic results. We always believed in it, but it has had a tough time, which was largely down to the currency issue. But I think it's doing what we always believed it could do. And it had been teased for a while that Airtel Money would be spun out at some point, but that's looking much more imminent now. So that's, I think, again, very exciting. And you did touch on the share price performance, but it's actually, I think, this year, so year to date, it's up nearly 77%. And if you take out the defence companies, I think it's the second second top performer on the FTSE 100.
TIW special. Although in fairness, how did we find out? I think a listener told us to listen to it, to look at it actually.
No,
in fairness.
I think
Was it a quiet week?
It was exactly, that's right. And you thought, oh, I've never heard of this. It's a bit of a joke of a company.
Yeah, because I saw it was telecoms.
Yeah, that's right. And then covered it, and it's like, oh, it's quite interesting. And then dug into it over the next sort of couple of quarters and found what is a fantastic business.
Yes, and now starting to be reflected in the price. So.
Yeah, well, that's right, because it has been at a fairly subdued level for the last couple of years, certainly.
It'll be interesting to see what Airtel Money trades at on its own, because
it's
arguably still fairly cheap, because the core business is pretty decent itself.
Yeah. No, it's certainly exciting times. Okay, on to Reckitt then, which is a company I used to own. It's consumer goods, second only to Unilever on the FTSE 100. It's owner of Finish, Cillit Bang, Nurofen, Durex, and a number of other brands. They had their half-year results out with first half net revenue of £7 billion, reflecting like-for-like growth of 1.5%, 4.2% growth in its core operations, more than offset declines in non-core units that include Essentials Home, for which a disposal of approximately $4.8 billion has since been agreed. On a regional basis, emerging markets grew by 12.8%, with Europe and North America both showing low single-digit declines. Like-for-like volume and price growth accelerated through the period, helping underlying sales in the second quarter increase faster than markets forecast. Underlying operating profit grew by 7%, ignoring exchange rates, to £1.5 billion, reflecting both top-line growth and efficiency gains. Free cash flow fell 24.1% to £623 million, negatively impacted by restructuring costs. Net debt was up around £300 million to £8.4 billion. The interim dividend rose 5% to 84.4 pence, and a £1 billion share buyback has been announced. Full-year core like-for-like net revenue guidance has been upgraded from between 3 to 4% to over 4%, and the shares were up 9% in early trading. In terms of valuation, Reckitt has a market cap of £37 billion and trades at 14 times forward earnings, compared with the 10-year average of 19, and it has a prospective dividend yield of 4.3%. I thought it was a fairly mixed bag with these results. I mean, if you put it against the backdrop of the last couple of years, I think the results were pretty good, and I think the turnaround is taking shape. Issues that I would have with them are some of the declines that they've had in the core developed markets. I think that is a concern, because I think with these companies, you always want, even if it's sort of mid-single digit, you always want some progress there. Encouraging in terms of the emerging markets, and I think with your Reckitts and your Unilevers, perhaps the more exciting part of the business is always the emerging markets, which are far from saturated when it comes to, I suppose, premium home and consumer goods products. And that's what, I guess, where the future growth is, with that kind of growing middle class over there demanding the products. I think some of the issues are some of the weaker brands in there. We've covered it before when it had the difficulties in terms of how much it paid for its formula business, and that's now something that they are getting out of, but that's been a long-standing issue. And with slowing birth rates in China, and you've paid up a lot for the formula business, there are lots of those long-standing issues in Reckitt. You do feel with a new chief executive, he is beginning to turn the business round. For me, would I pay 14 times forward earnings? Probably not. I think you could buy Unilever, which is a similar, but I think a better business, which is not hugely more expensive, does have better brands, and I think is further ahead in the turnaround. So for me, I wouldn't go there again. Other things, not that it's exactly the same, but you can also pick up Diageo. Interestingly, they reported today, and we'll probably cover it next week, at sort of similar, maybe a little bit more expensive, which I would argue is a much, much better business than Reckitt for sort of similar valuation. So encouraging in some ways. I think you might point to the debt and that they're raising the dividends and doing a share buyback, and they might be better addressing that. But Sam, I'd welcome your thoughts.
I think you've preempted a lot of them. But yeah, I think in fairness to the company, I think this is probably the best set of results we've seen in like the last 2 years at least. So it seems that the business is being turned around. That being said, I don't love borrowing in order to buy back shares. Well, we'll see how they're doing actually, because if they're still quite low, I might be more forgiving. Yeah, they probably have been. I think when you look at that share price over 10 years, actually, in fairness to management, I'd maybe let them off there, because I think if management do continue to turn the business around, they have taken advantage of an opportunity where the share price has been the lowest it's been in 10 years and bought back shares then. So I think actually I'll let them off on that one. But like you, I do find the declines in Europe and North America concerning. And I think although it seems to have some signs of life in it, the turnaround still has a way to go. I think it's not a business I'll be hugely interested in anyway, but I know it's different and you've already touched on it. But yeah, if I was going to pay 14 times earnings for a business like this, I would get Diageo, because I think it's 14.15 at the minute or something like that. And I think I'd much rather have Diageo in the portfolio than Reckitt Benckiser. So yeah, not really of that much interest to me. And the fact that it's at a similar valuation to Diageo just means that although it might be reasonable compared to historical levels, I think you can do a lot better at similar valuations with other companies.
And it is interesting with a company like that, whether it would be a target for Procter & Gamble, something like that, because it does still have some really good quality brands. And arguably, when you look at the valuation in that industry, and obviously it doesn't make any sense for Diageo, but for something like a Procter & Gamble, I don't know, it's quite a big company, even sort of by UK standards still, but you do wonder about those sorts of things.
What Unilever market cap is?
I guess it would be about 100 to 120 billion.
I mean, it would be a big acquisition, but it's actually of a size where Unilever could probably swallow it up.
Yeah.
I don't know if they would, because I would argue that although there's some excellent brands in there, overall the quality's probably dilutive.
Yeah, I think for a Procter & Gamble, it would...
Or a Kraft Heinz.
Well, we should actually, we might cover them next week, because they have reported, and it's quite interesting, that they're trying to offload rather than acquire brands. So, anyway, or at least acquire more quality brands, I think. So right. Not that some of these ones aren't, but okay, on to our US company of the week then.
Coinbase. I can't remember if it's a debut or not. I feel like it is, but I'm not 100% sure. So they have come out with their Q2 results, and total revenue was $1.5 billion, and all these figures are in dollars, and that was down 26% quarter over quarter. Transaction revenue was $764 million, down 39%. Subscription and service revenue was $656 million, down 6%. And total operating expenses grew $193 million, or 15% quarter over quarter, to $1.5 billion. Driven by $307 million in expenses related to the data theft incident disclosed in May. Net income was $1.4 billion, however that's mainly due to $1.5 billion in pre-tax gains on strategic investments, so some of the crypto they hold has gone up. They've highlighted that the Genius Act was signed into law in July in the US, and that's the first ever US federal legislation for digital assets, establishing clear rules for USD stablecoin issuers. They said we anticipate July transaction revenue to be approximately $360 million. We expect Q3 subscription and services revenue to be within $665 to $745 million, driven primarily by higher average crypto prices and stable coin revenue. They said crypto spot volumes, both globally and in the US, were down 31% and 32% respectively quarter over quarter, against a market backdrop where we saw average crypto market capitalization approximately flat quarter over quarter and crypto asset volatility down 16% quarter over quarter. Over the past 2 years, 75% of global crypto trading volume has come from derivatives, yet the US market makes up only a fraction of this volume, which presents a significant growth opportunity. To grow this market, we launched the broadest suite of CFTC-regulated crypto perpetual futures products in the US in July, trading 24/7 and offering up to 10x intraday leverage. Just in case that investing in cryptocurrency wasn't already risky enough for you, you can now 10x that risk, closing a key gap in domestic market access. And we became the first US-regulated futures exchange to offer 24/7 futures trading for Bitcoin, Ethereum, Sol, and XRP, with weekend volumes now approaching weekday volumes. Coinbase is a custodian for over 80% of US Bitcoin and Ethereum ETF assets as at the end of Q2, so that's quite good actually. And in terms of valuation, they trade at a PE of 31, however the price to free cash flow is only 22. This isn't a company I follow that closely. I'm surprised the results were this poor, but that's just, it's very sort of first level thinking, whereas it felt like, obviously we've got Bitcoin at all-time highs, so that's done pretty well recently. Might not be at all-time highs now, but it hit one pretty recently. And it did seem like my Dogecoin showed brief signs of coming back to life a few weeks ago. So yeah, I just got the impression the crypto market was doing quite well, but it just seems like, although the market itself seems to be doing okay, people aren't really trading. And I think it's just a very, very difficult market to predict. As well, I think at a PE of 31, appreciate the price of free cash flow is lower. It's not hugely cheap. And I think for me, I would always want some kind of discount because it is just such a hard business to predict. And since listing in 2021, it's basically flat. It's delivered no returns really for shareholders. And as well, I think, well, what would you be buying it for? I think the main argument for buying it would be really if you wanted some kind of exposure to crypto, but didn't want to actually buy the underlying asset. So you wanted like a picks and shovels play. I think for me, it would probably have to be quite a bit cheaper for me to take a serious look at it, because I think it's quite a volatile, difficult to predict company. And yeah, I think 31 times earnings or whatever it is, I'd probably want to see it about half that before I actually took any serious interest. What about you, John?
Yeah, I think it's similar to that. I own a bit of crypto in the form of Bitcoin, and it's very much just buy and hold and see what happens. There is an element of a large element of speculation there, but no, I think it's expensive. It's very volatile, and you're not necessarily seeing it, correlate with the price of Bitcoin or crypto for that matter. So it's just one I think I'd stay away from.
I would argue as well, actually, just a thought I've had now. I think a lot of the arguments that we will use to make when I held Hargreaves Lansdown probably apply. Obviously, it's a much earlier market, but it's probably going to end up being a race to the bottom in terms of the prices it can charge.
Yeah, I would actually agree with you there. I think that's another problem. It does have that sort of household name of
first mover advantage, I guess.
Yeah, that's right. And I suppose it's got that, respectability that it's kind of established as a result. But yeah, no, it's not one for me.
Right then, of the 6 businesses we've covered this week, Centrica, Rightmove, Primary Health Properties, Airtel Africa, Reckitt Benckiser and Coinbase, which do you like the most, which do you like the least?
Well, it's a difficult one. I think Airtel Africa, fantastic. And Rightmove too. I think what I'd be looking at, as I have both Rightmove and Airtel Africa, is probably Primary Health Properties. I think that looks really attractive at the moment, and I may well take a position in that soon. In terms of what comes bottom, probably Coinbase, although, I'm not enamoured by either Centrica or Reckitt.
I think for me, I'd probably put Airtel Africa number 1. Very happy with those results. I know it has gone up in price quite a bit, but I still think with the quality of that Airtel Money business, I think you could still make a reasonable argument for it on valuation. That being said, I will not be topping it up. In terms of bottom, it's just Centrica. I think it's uninvestable, whereas Coinbase, I'd probably rather have Coinbase than Centrica, just because at least it's not going to hit with a surplus profits tax anytime soon. And that for me is the issue with Centrica. It's just uninvestable.
Yeah, fair enough. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.